Hi and welcome. This is Load with Black Bear Dog Trading, and I'm just going to jump right into this video. We have a lot of ground to cover. As I mentioned in the prior video, there are two trading models that traders tend to use predominantly. Retail traders tend to use what's called the fixed model predominantly, while professional and institutional traders tend to use more the dynamic model of trading. But what is fixed model versus dynamic model, and which one should you really be using? Well, let's start with number one, fixed model. As I said, that has been used mostly by retail traders for its simplicity, straightforwardness, and there isn't much to keep in mind or complicated math to have to deal with or formulas to remember. It's just straightforward X number of dollars or percentage you risk, X number of lot size, X number of stop loss, X number of trade profit. All these things are fixed, and retail traders find that relatively easy to learn, to manage, and to operate. But there's a big problem with fixed, and fixed is that it doesn't adjust to market conditions. Markets aren't always operating under the same conditions. As I mentioned in prior video, they are controlled by two factors predominantly, being momentum and being volatility. Momentum determines the strength of the asset that you're trading, or aka the trend, and volatility determines the price movement up and down over a certain period of time, but without telling you what direction it is going. So these two components, they can make a major difference in how the market reacts, how the market moves, and they can suddenly change, especially when there is breaking news without notice or warning, and hence a fixed model doesn't work because your fixed stop loss of, for example, 100 pips may be way too little when market is very volatile, meaning price is really going, and it may be too much of a risk exposure when market is volatility is hardly existing, meaning price is just going slowly like that. So that brings us to the dynamic portion. By the way, before I go to dynamic, the fixed model is also the reason why so many traders don't make it. The trading model is too rigid. Everything is, like I said, basically it's cut in stone. You can't change it. It's a 100 pip stop loss. It's a 1.2 lot size. It's a 2-to-1 profit ratio. I mean, it's a trailing stop with with exactly 50-step increment, so forth and so forth. It's too fixed. It's too rigid. It doesn't adapt to market conditions, and so traders long term tend to lose, and retail traders in specifically, because that is what they the trading model that they learned, and that is also the trading model they rely on for their execution, because it's a lot easier than is a dynamic model. So now let's move on to a dynamic model. So what is a dynamic model? Well, as the word implies, it's dynamic. It adjusts to market conditions. For example, if the market is very volatile, it behooves to have a larger stop loss than when the market is barely moving at all. You can get away with a much tighter stop loss, and you still won't get stumped out. In addition, because the stop losses are automatically adjusted to market conditions, you now risk an appropriate amount as opposed to overexposing yourself. What do I mean with that? Well, for example, markets are very volatile, let's say, right now at this point in time, and you have a basic stop loss that you start from. That's your starting point of 100 pips. But your trading method knows that the market is very volatile, so it automatically adjusts the stop loss to, let's just say, 150 pips. Now you have less probability of getting stumped out because your stop loss got triggered because it adjusts with market volatility. The same when volatility is hardly existing or markets going sideways, there's barely any movement, and now you can afford to have a smaller stop loss, but your preset stop loss is 100 pips. In a fixed model, it would still be 100 pips, and you would risking too much. You would expose too much of your money for just low volatility. Again, in a dynamic situation, that 100 pips would be readjusted automatically on market conditions. Volatility is low, trend is weak, and the 100 pips may be reduced to, let's say, 50 pips. So it is clear, dynamic trading is definitely a much better way of trading. But of course, there is a problem with that. And the problem is that all these factors change and they have to constantly be updated and constantly be monitored and constantly be recalculated so that doing this manually is not only very impractical, it is nearly impossible. And that's where algos or algorithms come into play. And that brings us then to a third model. And the third model is basically the best of both worlds. It's a combination of both the fixed model combined with the dynamic model. And it's called the hybrid model. So what is a hybrid model? Well, things stay fixed are, for example, and that's just an example. This is not an actual trading strategy. It may be, but this is just off the top of my head. For example, you use a 13 EMA and a 34 EMA and an RSI to monitor entry and exit positions. The fixed portion of your strategy is the condition that you rely on for entering a position. For example, a buy position is that the 13 EMA must be above the 34 EMA, price must be above the 13 EMA, and RSI level must be above 50. Again, these are just off the top of my head. This is not an actual tested strategy. Please don't start implementing this without testing it first. It may work, it may not work. No guarantees here. This is just to prove a point. This is the core of your trading strategy that you base your entry decision on. This stays fixed. And it stays fixed because this has nothing to do with whether the trend is strong or weak. It has nothing to do with whether there is high movement on the market or barely any movement at all. This condition stays regardless of market condition. So that's fixed. Dynamic, on the other hand, are those factors that must adapt to market condition. And as I mentioned already, one of them is stop loss. There are more. Lot size based on if you have high spread, greater risk appetite, also your account balance, combinations of those. Also there is stop loss, there is trailing stop loss, and there are several indicators as well that you can set up dynamically so they adjust to market volatility and trend as well. And in my case, the one that I use is CCI, where I have a default buffer zone up or down of 40 or minus 40, but based on market volatility, that may automatically adjust to plus 10, minus 10 during low volatility, or plus 60, minus 60 to high volatility. So there are several factors. These factors, as you've probably got the picture already, are all related to risk management. The essence of dynamic is risking the least amount of capital but creating the most amount of profit. And so by combining dynamic with the fixed, you then have the hybrid model. Well, obviously, just by what I've said thus far, hybrid model must be automated. There have to be algorithms, or algos as they're commonly called, that monitor this for you and make instantly adjustments according to market condition, even to the point when there is sudden breaking news that could send the market spiraling up or spiraling down, and your stop loss gets automatically adjusted to that, for example, or your trailing stop gets adjusted to that. So that's why a hybrid is the best of both worlds. It combines fixed with dynamic, and it combines the both. But again, tracking that manually is not possible. So the hybrid model is the way to go, and you need algos to rely on this. I'll talk more about this in an upcoming video, but to help you get a better understanding of all the stuff I just explained, you can do one of two things or both. You can rewatch this video until you grasp the concept, or if you want, you can download my booklet. The link is below, and it gives you everything that I mentioned, but in clear, precise context, so that it's easier to grasp. It lists all the pros and cons of both the fixed and the dynamic. It lists how a hybrid model works, how a dynamic model works, how a fixed model works. I mean, it is not a long read, but it's pretty intense. So download it if you want to. Again, the link is below, free of charge as always. And that is it for now. The weekend is upon us. Please be safe, have fun, and as always, God bless.